So just to introduce Tariq, guys. So Tariq is one of my favorite speakers on Clubhouse, and I'm really happy to have him here on Indians Invest Globally. This is his first time here. Tariq has spoken previously at Sahir's room. He's also spoken at Bloomberg Quint's recent webinar event, and Tariq used to work for Goldman Sachs. He left his job there and is now doing data science at Visa. Um, he made this shift in part because he wanted to focus and have the ability to invest in direct equity, which his previous job didn't allow for. He is a very structured thinker and someone who has a very established process. And I think that along with me, all the investors in this room today can benefit a lot from his experience. So with that, I just want to welcome Tariq to the room. Hi Tariq, how is it going?
Thank you. Going good. Very kind words, and thank you for introducing me.
Awesome. So I just want to start by getting your perspective on how you got involved with investing internationally. When was it that you made your first investment? How long into your investment journey was that, and what made you make that decision?
Sure. So for me, the international investing was pretty much very like it wasn't like that. I only wanted to invest in Indian stocks when I started out. Like it was the obvious thing to do because like you don't have all the companies in the world available. So for me, if somebody tries to limit themselves, and this is also known as, this is one of the major biases, home country bias, which is very famous in the investing community. Most people tend to, around the world, tend to focus on their home country, even though you have a lot of global opportunities available to invest. So for me, I started first with international investing, and then started focusing at Indian companies. But for me, global investing is the obvious thing to do, because why do you want to limit yourselves to just 4,000 companies in India, out of which maybe there are like 500 to 1,000 companies that are investable? So might as well have the entire world available to you, especially because it's so easy to invest now.
Awesome. And what was, just out of curiosity, what was your first international investment?
So my first international investment was right after I left Goldman, and that was this company called like I bought some shares of Shopify because I missed out on that one when I was at Goldman and couldn't invest. But since then, I've basically used international investing to kind of invest in themes and emerging themes that are not available in India. So Shopify was the first one, but since then I have kind of have a substantial portfolio in US stocks.
So what would your split be like between India and international? And do you hold any other asset classes?
Internationally, I think if I combine China and US investments, it would be 30% of my equities portfolio. And when it comes to asset classes, I don't usually invest beyond equities, simply because I'm like pretty young. I can take risk, and in terms of that, I'm majorly aligned and weighted towards international stocks. Um in terms of other asset classes, I have sovereign bonds and I have like debt funds, which are mostly focused on Indian equities.
Okay, and a lot of people have requested me to ask you this question, which is, what is your opinion about crypto?
So crypto, I actually started investing in crypto in 2016 uh, because there was no other thing to invest. That was the only investable, that on mutual funds was allowed at Goldman. So I like it. It's a good place to be if you are somebody who can afford to invest. Then put like one. I have like 1% of my portfolio in crypto, uh, but I don't usually do more than that, because I've seen the kind of like I've gone through the 2018 2017 crash, so I know what it's like when the crypto uh, tide kind of runs off. You go through a year of 70-80% drawdowns without any movements. So Bitcoin today is moving above 69,000, above it's coming entering now 70,000 territory. But there was a time when Bitcoin crashed 60% down, and it didn't move. It used to move like 1-2% a day. Um, so overnight things can change, and I still remember that time when things kind of crypto used to be very hot in 2017 towards the end, and suddenly in December, just days before Christmas, everything changed, and you wouldn't even realize. So don't invest everything into crypto, but it's a emerging place to be in. Um, it's not going to go away as everybody says it is, but it's also not going to take and replace your INR and US dollars. So somewhere between that, there will be some cases for crypto.
Awesome, awesome. And I'm curious now. Since you have a 30% allocation to international, how do you move your asset allocation between India and US? And basically India and global.
I don't usually move it. So I don't think of it in terms of I need to be invested in India or I need to have this much portfolio in US or China. I look at companies from bottom up. If I find opportunities, then I'll go after them. So to give you an example, I recently invested in this company called Rocket Lab in US, and it's a very small investment simply because it's an emerging space. It's going to take at least the next 5-6 years for it to for this like the space economy to kind of even become a thing and become investable. So it's things like that where I have optionalities. I have investments which are not available or themes that are not available in India. I'll go after them, and it's not like that I need to have 60 or 70% portfolio in India, 10% in China, and rest in US. I'm more looking at bottoms up, where I find good opportunities that can scale up over the next 10 years.
So this would be still like more like a static allocation. It won't depend so much on market conditions.
Yeah, I don't look at market conditions a lot. I mostly going through it. My major uh, so my major target from now to the next 5 years is to invest as much as I can. And when you have that kind of a time horizon, if you're someone who's around my age, you don't need to look at market conditions that much. Simply look at companies from bottom up. Look at companies that are doing good. Market conditions will take its own. Like market has a cyclicality of almost 2.5 to 3 years, where every 3 year you face a 10%, 15% correction. Uh, so there will be, if you have a 12-year horizon, you will face at least four of those corrections, and every 5 years market crash by more than 30%. So if you are more concerned about what's the next big thing at a macro level, what the Fed policy is like, or what's happening in India, what the GDP growth rate is, all of that, you will always find something to worry about. If you focus on bottom up companies that are growing organically, that have good balance sheets and have good prospects in their industry, they will do well no matter what the economic cycle is.
Makes sense. Makes sense. So, what are some of the themes that you're excited about in the international space right now?
Sure. So, space is one of them. It's a theme that is not discussed a lot, but I think it's one of the areas where you can make considerable amounts of wealth in the next 10 or 15 years. It's a very nascent industry. It's dominated by a single firm today, which is doing its own thing, but there are tiny firms that are emerging and building an industry around it. So that's one. Then around that, I'm invested into gaming and metaverse. I have a substantial investment in Roblox. Uh, then I like e-commerce area, targeted e-commerce in US, and those I will say is the top three themes.
So, just to give our audience a sense, metaverse is also something that I've been looking into, having been a gamer myself and also seeing this trend go out. But how do you visualize the metaverse planning out, on a more conceptual level, and where do you see the value creation opportunities in the field?
So it's very early to say that, and the reason I don't want to opine on what metaverse will be like is because nobody really knows. But what I do know is that there will be some companies that are already have a considerable advantage or a leg up in that area. So Facebook is one of them. Second comes is Roblox, and the reason I started looking at Roblox was majorly because of their gaming. But then I kind of found out that they never designed the company to be a game company. They designed it to be a metaverse company, and gaming was one of the areas where they forayed into it to kind of help them earn some money while they are doing that. So if you if you're considering investing in these emerging themes, look at these kind of companies which are already have a good leg up and have a huge chance of success. So Roblox, for example, is tied up with Tencent. They have them as an investor on board. They have the China operations has a joint venture with Tencent, and they have substantial money on their balance sheet. And they have one of the largest use pool of users who are kind of uh, in the theme of metaverse, if you want to say that, call it that. So that's an investment where for that company to not succeed in this emerging industry, it would take a lot of headwinds and to go something really wrong. Whereas if you're investing in a company which is just brand new, maybe for a year has been running its operations, doesn't have a lot of users or doesn't have a product, then that's a bet. That's not an investment. So I hope you get that. Like that. That's basically what I'm thinking about when I'm investing.
Have you looked at names like Unity and Matterport? Have you checked them out?
So Unity I have, Metapod I don't know. The reason I have not invested in Unity because I think it's a good company, but I see Unreal Engine to be kind of like very far in terms of their development versus Unity.
And you've got exposure to Unreal through Tencent, right? Through
Yes,
your mutual fund in China.
yes, that's correct.
Cool. Yeah. Just to also give our viewers a pointer. Last week we had Luke on, and Luke has done a podcast on the company Matterport. So Matterport does 3D visualization of real spaces, and they do it for as low as $1 a month. You can host a virtual space, which would be an exact replica of its real world equivalent, and you can use their app to basically scan any physical space. It won't be as good as their professional cameras, which is
Yeah.
their hardware business, their legacy business. But they also have the ability to, to do this kind of scanning work from mobiles. They've just launched on Android, so I thought
Okay.
that would also be a really cool, pointers to sort of leave the audience with, who weren't able to make it last time because of the cricket match. So yeah, guys, check out Luke's podcast on Matterport. With that, let's move on to e-commerce.
Okay.
The e-commerce space right now, internationally, and how do you want to position yourself accordingly?
Sure. So internationally, if you look at e-commerce, what I believe is happening is there are two things that are going on. One is the emergence of vertical e-commerce players. So, for example, Nika, which is focused at a particular vertical in the industry, which is beauty and fashion. Similarly, you will find specific vertical oriented e-commerce players that are coming up. Secondly, is the horizontal, which is your Flipkarts and Amazons of the world that are they build a distribution network and then they leverage that distribution network to kind of create a platform, e-commerce platform for everybody. So within these two, the horizontal one, you would see there are giants and gorillas like Amazon operating. Then there are very tiny firms that are compared to Amazon, they are tiny, and they are operating in a specific geography. So you have Russia specific. You have a company called Olo, which operates in Russia. You have a company which is operates in the uh, South American part of the world. Then you have a company called Coupang, which is Korea specific. So these are emerging geographical heavy players, which I think can do well in some cases. So I have some investment in Coupang. I have not looked at the uh, Russia one because I don't think there's a geographical stability there. So I've discounted that zone completely. So I think e-commerce can be, especially specific area dedicated e-commerce can be an area which is good. So that's one area that I'm invested in. So Coupang is one of the one.
Can you just explain Coupang's business model just briefly?
Sure. So Coupang is basically, if I have to explain in one line, is basically Amazon of South Korea. The It was started almost a decade ago, and the company's founder has basically he's an admirer of what Jeff Bezos has done. So he has basically replicated and copied his entire playbook. They started with one item delivery in South Korea, and now they kind of deliver everything. Their model is to be faster and better than Amazon. What they have been able to achieve is basically if you order, while Amazon has in some cases 1 day delivery and same day delivery, they have gone to the extent of Coupang has expanded its delivery capabilities to the extent of overnight shipping. So if you do, let's say, at an order before 12 in a particular day, before morning 4 a.m., it will be at your door. And that model has become really popular in South Korea, and Coupang over the years has taken over the market share from pretty much everybody in that space. Uh, since Amazon also kind of explored and ventured into other areas like videos via Prime Video, music, and all the other things. Similarly, Coupang is basically kind of doing that. Most e-commerce companies are not profitable, so you wouldn't. Coupang is also not profitable; it's burning cash. But at the same time, because it's kind of become that level of operations, it's very hard to kind of compete with Coupang as a new player, especially in their 4 hour delivery model.
That's really cool. Have you checked out Mercado Libre and what they're doing in Latin America?
Yeah, that's what I meant by South America. And I have not invested in Mercado basically because I had missed the boat by the time it kind of took off. Since then, I've stayed away, but it's under my watch list. I've uh, reviewed and studied the company a little bit.
Cool. And just because I know this is slightly outside the scope of what we're discussing today, but is this the same theme that you see playing out with Nika?
Um, Kind of in a way. So if I forget about valuations of Nika, I do believe the majority of Nika's let's say gross merchandise value is actually migrating towards tier 2 and tier 3 cities, and there's a very good reason because you don't have enough stock available in these countries, in these cities. So if you go to a shop, you wouldn't have all the shades of whatever cosmetics you're trying to buy, and you wouldn't have all the products. And even if they do, you have a very big problem of authenticity. So Nika is kind of actually getting more orders online in tier 2 and tier 3. And as India kind of progresses through it, and most of the development in the coming decade, I believe, will happen in tier 2 and tier 3 cities, simply because that's where the crux majority of development is left. So as the population in those areas kind of become more well off, they have more disposable income, you will see Nika growing more exponentially there. um, so I have it's a very good investment case for Nika, but I don't know about valuation, so I'm kind of forgotten about that part.
Yeah, makes sense. I think that's the same reason why I've personally stayed away as well. Um, I think this is a perfect time to drop that disclaimer, guys. Everything that we discuss here, it's not to be treated as investment advice. Please go ahead and do your own research before investing. Also, I want to do another quick shout out for Tariq. If for some reason you've landed up on this clubhouse without following Tariq on Twitter, then please go follow him. His Twitter handle it goes as at the rate it's TARH. I will also tweet it out from my handle right after this event because for some reason Tariq, your Twitter is not integrated into your Clubhouse account, right?
Yeah, it's not. I barely use Clubhouse, so
Yeah. So I'll tweet it out as well, and if you want to go check it out right now, it's at the rate it's TARH. Um, Definitely go follow him because
thank you.
he puts out some of the most thoughtful and well researched content on Twitter. Uh, with that, let's move on to how you've constructed your international part of the portfolio. I think last time on Investors India, you had mentioned that um, all your Chinese exposure, roughly about 10% of your total portfolio, is only through the Edelweiss Greater China Fund.
Yeah.
Um, what about the remaining 20%? How have you allocated that? Is it as concentrated as your Indian portfolio is?
Kind of. So out of that, so some part of it is in the index, like Nasdaq index fund, and some part of it is in concentrated into a few investments. And the reason I do that is because I'm basically taking my time to research these companies, and whenever I find it, I take the money out of Nasdaq and put it into a concentrated fund, concentrated investment. So, if, for example, Rocket Lab, when I wanted to invest, I spent about a month and a half kind of researching, and I always was interested into space. So I knew about Rocket Lab much before. But the moment they kind of became a public company, I took the money out from the index fund and put it into that into the same company. And the reason I do that is because the parking my I see index fund as a way to for me to park the money in, and if the index goes up, that's good. If it doesn't go up, that's also is fine.
Makes sense. Makes sense. Um, Also, just to get your sense, when you invest internationally, you do look at the sector and the theme first, and then you go ahead and do bottoms up analysis of each company. Is that right?
That's correct. Yes. So I'm not looking at let's say a company value should be $25 and today's available for $10 and I'll buy it. That's I'm not interested in those areas. I'm more interested in areas where the industry and the company today is only $10, but 10 years from now that industry will be $1,000 and the company may be 100 in that case. So that's what I'm focused at. Uh, Traditional value investing I don't really agree to, where you buy cigar butts and kind of sell them once they reach a certain value. I think I've kind of arrived at a style where I've kind of mixed growth investing with value. I don't buy growth companies at any price. If there's enough margin of safety available for them, I kind of do that. uh, so I buy those companies. Yeah.
And how would you look at margin of safety when you are investing in unprofitable companies?
Sure. So the way I look at is through. So if I continue with the example of Rocket Lab, so that today the entire company I think is less than worth $5 billion, and uh, the the if I look at the entire industry, there's only two companies that are able to uh, put uh, payload orbits into low Earth orbit in the world. One is SpaceX. You can't invest in SpaceX. It's also very expensive. It's almost $100 billion company now, privately held. The second company was Rocket Lab. There's no other company in the world, private company in the world, that can put any that has the authority or the license or the capability to kind of put payloads into low Earth orbits in the world. And Rocket Lab is the only one who's kind of done it apart from SpaceX on a continuous way. And Rocket Lab is also another company that can get its boosters back on Earth again for reuse. So when you look at all of that, and the company, company number one is valued at $100 billion. Company number two is valued at less than $5 billion. It's a tiny company compared to SpaceX. Doesn't have that much capability, but obviously it doesn't make sense for a $95 billion gap in value. So that's an example of how I think about margin of safety.
And can we take that a little bit more into Kupang's case, because
Sure.
uh, um, Rocket Lab is in a very niche industry, so
Yeah.
there aren't peers, so valuation becomes harder to calculate. When we look at something like Nika, we see that it's expensive. So what makes Kupang less expensive?
Yeah, good question. So Kupak, I when I bought Rocket Lab, I made a big allocation. In Kumbag, my allocation is less than 2%, and simply because when I bought it, it was almost available at like $50. Then, as and when it kind of kept coming down, I've kept averaging down, but still have that allocation has not gone above 2%. So once it kind of comes down, it's almost a $46 billion company today. Uh, I think that's a very stretched valuation, but because I have not invested a lot in there, it's still available for much cheaper than Nika is, and has a very significant moat around it when it comes to geography and technology and their logistics capability that's there. So the moment it kind of comes down closer to my level of valuation, I'll keep on increasing my stake in there as long as the company also performs.
Makes sense. Makes sense. Um, so also when you look at these companies abroad, right? It's harder to do scuttlebutt. It's harder to do analysis. So what are some of the tools that you use to do research on the companies and get the insights that you do?
Sure. So personally, I find researching US companies and even Chinese companies sometimes easier than Indian companies, because they do have a lot of uh, investor presentation and a lot of easily available content. And in US, you have all these forms like 10K, as well as all the forms that the companies have to do. And you have a very good tool from Securities and Exchange Board called Edgar. If you kind of use that, you can kind of search at any document from that is filed by any listed company in the US, or any company that is listed somewhere else, but also has listed in some second listing in US. So, for example, Chinese companies, you'll find filings for them as well, though they are not as deep as extensive as the other filings by US companies. So, Edgar is one of them. The second tool is called Ticker, which I use. It's a screener, TIKR, ticker.com. Uh, it's a screener that is being built by some people, and for now it's free, but eventually it will be paid. But it's a very good tool to kind of research any stock, even Indian stocks. You can research Chinese stocks, UK stocks, US stocks, any stock in the world. You can kind of research that. They have a lot of good data on conference calls, a lot of good data on valuations. So pretty good tool there. Apart from these two, I don't see, and company's website, I have never ventured out and use another tool, or had the need to use another tool.
And my next question is around, what are your return expectations like with these companies, and how is it different from the Indian companies that you hold?
Sure. So at a portfolio level, my goal return is 25% over a course of 10 years. That's the best case scenario. Uh, then between 20 to 25% is where I aim at a portfolio level. With these companies, like for example, I don't Rocket Lab, my investment I know is not going to pay any returns to me for the next, let's say, 4 or 5 years. So I have that in mind. And when I do my position sizing, I'm taking that into account. and I'm taking my 25% kind of goal return over a course of 10 years into account. So as and when Rocket Lab kind of increases, I'll or other companies in US or China kind of increases, I'll increase my weightage there compared to India. So it's a matter of portfolio weightage rather than my target return, because at a portfolio level I want 25% CAGR for 10 years. So I'm optimizing my investments via allocation to achieve that target.
Also, I wanted to know, in so when you have these companies which you have to wait out for longer periods of time,
Yeah.
how much of your portfolio at a portfolio level will you be willing to allocate to these companies, knowing that returns may not come for a year or two or
Um,
even longer?
so I scale it up. I would say, um, so because I'm constantly adding money to my portfolio, I don't look at it that way. I look at more in the terms of, so for example, right now, if I had to take a decision to whatever cash I have, if I have to kind of invest that, I would look at which market is kind of doing well or where in my portfolio there's value available. So Indian stocks have gone through a significant correction in the last month or so, month and a half. So I would rather invest my all my new money there, and because I did that, my weightage to US stocks will automatically reduce. 3 months ago, I was in 3 months ago I was investing more into Chinese stocks when it was at the bottom. So my weightage to Indian stocks went down, but Chinese stocks went up. But because Chinese stocks are now performing, US stocks are now performing, so I'm kind of putting money into Indian stocks, whichever is cheaper.
Cool. I also have this as a sort of slightly macro level question. When you look at these investable economies around the world,
Yeah.
besides US and China, do you see scope anywhere else or any other economy that's currently exciting you?
Um, Latin America is a good place if you want to look out. Then there are a few companies in UK as well. Uh, but at a market level, when you look at it, you would have to do a bottoms up fishing in those economies and markets rather than kind of just buy the index for those markets, kind of investing. So in terms of like top three where you can kind of just buy the index and call it a day, it would be China, US, and India. But UK and Latin America, I would kind of, if you want to venture out, do a bottom up fishing, you will find a lot of good companies in those areas.
Cool. I think from my side, I've covered all the questions that I had. I think we'll open it up to the audience.
Sure, sounds good. There are like
Cool.
520 people, so awesome.
Yeah, cool. So let's. I'm going to open it up to the audience. Please message me your questions, and I'll pull you up one by one. If you're a regular and you're here and I know you, then just raise your hand. But if you're somebody who's new or hasn't been super regular, then please message me your question and I'll pull you up. Hi, Srinivasan, sir. Do you have a question or do you want to share something?
No, I did have a question. I did miss the first 10 minutes. I'm not sure whether it was covered there, but definitely the last part was quite intriguing. When he said that in China, India, and the US, you could buy the index, right? So I want to get Tariq's comments on, obviously we are looking at stock picking, specific stocks and all the stuff.
Yeah.
And it's quite interesting to hear him also talk about index. So I just want to get his thoughts on why he would say index would work for these countries, and why you need the bottoms up stock picking for other countries. Thank you.
Sure. Okay. So that's a good question. So first of all, index works for a country like US and China because they're pretty much the top two economies in the world. And the index is like, in case of US, if I take the example, it's a perfect market. It's a free market. There's no like circuit breakers, or there's no uh, like ASM kind of list that's happening in the US. Stock can go up 100% in a day, a stock can come down 100% in a day. And so in the US, when I'm kind of investing in the index, I'm also uh, leveraging the index investment in a way to kind of not have geographic risk concentration in my portfolio. Like, not everything is invested into, let's say, Indian equities. I'm using the index when I kind of need that kind of diversification. And also, index is more stable compared to individual stocks. So it's a way for me to park the money in. And if somebody is kind of interested in bottoms up, then you can kind of uh, go around, look for companies. So I usually start with kind of at putting a good chunk of allocation to the index, and when I find companies within that geography, I kind of take the money out of from the index and put it. In case of China, I do track China very closely, sometimes even closer than US. And I think a lot of is misunderstood about China. I believe um, there's a ample opportunity available in Chinese, even the index, to kind of in the next decade. Especially today, a month ago it was even better. But even today, Chinese indexes are like down to where they were around COVID. So it's very funny to me that the second largest economy that will overtake US in the coming decade and become the largest economy in the world is available for a price that is there when COVID. So that's why I say, like, China and US, you can kind of do index investing. In Latin America and UK as a business is not has done the UK stock market hasn't done very well over the last decade or so, and mostly because their policies are kind of not that business friendly. There's some of the harshest environmental and climate regulations there. So that's why you kind of, if you do bottoms up picking, you can kind of make good money there. There's some good companies. In Latin America, it's a geographic risk, political stability risk, but it's one of the areas where you have most of the money in the world is actually going in those areas. If like India is well on its way to becoming a developed country, but let's say if you had to find India 20 years ago, then you right now that kind of environment is where Africa and Latin America countries are there.
Thank you, Tarik. And definitely, I use the word, index is scalable, right? So whatever money you want to put in equity, you can definitely put it in an index, and then look for opportunities to look at
Exactly.
specific stocks. So great
Exactly.
for adding that. Thank you.
Thank you.
Just before we move on, I want to clarify that once you send me the question in the DM, please also raise your hand. So the question is appropriate, I'll pull you up. So send me the question and at the same time raise your hand as well. Cool. Srinivasan sir, if you have any other questions, if not, then we can move to Mohit.
Yeah, please go with one. Thank you.
Mohit, it's up to you now, bro.
Okay, thanks a lot, Krishna. Hi, Tar. It's been a great
Hey,
session so far.
hey Mohit. Thank
Thank
you.
you so much, Krishna, for providing the platform. It has always been a great discussion every week. So my question is that since you also take positions in index funds and do stock picking on the side as well, if you find any great opportunity, so sometimes does it not happen that your in stock picking strategy goes against the index fund strategy that you're investing in? Suppose, in a hypothetical scenario, suppose you're going into value strategy for your index fund investments and you're getting a growth strategy for your stock picking investments. So it might happen that when you're dropping or selling off a stock because it is not giving that kind of growth and the market is not giving it that kind of value, the value index fund in your portfolio might be picking it up because it has become cheap in comparison to the other ones in the
Uh,
same industry.
Okay, so it's a couple of things there. First thing is I don't go via a strategy like a value strategy. Like I said, like in the talk earlier, like I'm not interested in buying something at 10 and selling it at 15. I'm interested in buying a company at 10 when the industry is at 100 and selling that 10 years from now when industry may be at 10,000 and the company may be at 100 or above 100. So my strategy is to invest in areas where there's growth, but also at a reasonable valuation for that growth. I don't buy growth at any price. And index for me is just to kind of get the geographic risk away. So, for example, if I was concentrated all into US Indian equities, my portfolio. Over the last month or so, it would have seen considerable drawdown. But because I was geographically diversified, I hadn't had a drawdown. Instead, my portfolio returned 2.2% last month when all the indexes in October kind of went down. Uh, so that's where I'm kind of uh, managing my down risk via geographic diversification. Uh, and if I don't find any ideas, I park it in an index in that country. Uh, but most all my investments are made into the areas where they can grow, and if they don't work out, it's fine. I don't sell them just because they have gone down below my buying price. I'm more interested in what the business is kind of doing. If the company is kind of making progress every year, every and quarterly numbers are good, there's no headwinds in the industry for the company, I would remain invested even if it goes below my price, or even if it kind of goes much above the value. So I'll give you an example of IEX where I'm invested. It is way past its logical valuations, but I'm still invested because I see a lot of triggers in the next year for the company, with the Electricity Amendment Act kind of kicking in, getting approved in December, in the winter session of the Indian Parliament. Then most with the MBED phase one kind of coming in. So I kind of see a lot of triggers for that company. So even though it's overvalued, I've stayed invested. But when a company does become overvalued, I kind of sell it out if there's no valuation comfort in there.
Okay, okay. Thanks a lot. So I'm assuming that the index fund you're referring to is basically you're taking a position in beta in overall index fund of a company. Suppose if you're investing in India, you take a position in the Nifty 500,
Yeah, yeah,
uh, and in US, you'd be taking a position in S&P 500. I'm assuming.
yeah. I prefer Nasdaq over S&P just because it's more diversified. Uh,
Nasdaq
so
is very tech heavy, is it not?
Not really. The S&P, about 50% of it is tech. Nasdaq has biotech names. Apart from finance, Nasdaq has most names. It's not just technology companies. Like companies like
Okay.
Costco are part of Nasdaq, for example.
Okay, okay, cool. Just one more question. That what's your checklist for shifting your money from an index fund to an individual stock? And what's your first position size? Look, do you judge performance and gradually increase your position size according to that?
Yeah. So first question is the strategy to shift money from index to stocks is uh, the index is just there for parking. So whenever I find a good idea, I'll take the money out of that index and put it in that country's stock. The second question, sorry, what was the second question?
What's your position size like
Oh yeah,
when you
position
find
size.
an opportunity?
Yes. So position size depends on the valuation. So, for example, I will give you an example of Hero. Hero in India, it's available for a very good valuation according to me. So, I kind of bought a big chunk of the company. I have about 10% weightage of my portfolio in it. Uh, but I'll take the example of Rocket Lab or Coupang. They when I started investing in there, they weren't available at very good valuations. So I'm kind of invest it slowly, and I started at less, like about a percent allocation, and I kind of slowly increase it to the point where they become 7%. 7% in my portfolio is a good solid position, and that only happens either when the company is available for cheap and has good uh, don't have any headwinds and kind of have good triggers in the next year or two. That's when it kind of goes above 7%. If a company doesn't have, if I'm building position in it, it might even take me years to build a position in some cases, or it may take me months, depends on what the industry is like, what the triggers are going to be like in the next few years. That's where I'm looking at. So for example, Rocket Lab doesn't have a trigger in the next year or two, whereas Hero has a trigger in the next year. So I have a larger chunk in Hero, very less chunk in Rocket Lab.
So how do you arrive at the fair valuation which you feel comfortable in? Do you do DCF or do you look at the technicals with the support and the breakouts and everything?
Valuation is a very it's a very subjective matter. I'm not doing DCF. I'm not interested in precise value. I'm interested in a ballpark value where a company should be. So for me, valuation is a sum of lot of factors which are sometimes not, like, for example, 10 if you have a checklist or a 10 criterias, they might meet a criteria in a company like Hero, but in a company like Rocket Lab you might only need to meet 5 of those criterias to invest. So it's a very subjective, it depends on the company. I don't have a sure short answer or a formula here where if it's below a certain P you can invest, or certain that number. It depends on it. So for me, when I was kind of uh, evaluating investment in Hero, I looked at what the sales of the company might be in 2 years or 2 years down the line. And it for me I and for me it seems to me that the company's market cap today, it can do as much sales, add as more than that much sales in the coming year. So for when I look at that way, and I also kind of consider if the sales are going to increase, what are the trigger points for that. So Hero has a very good spare part business that's growing. They have partnerships with Harley to get into premium segment. They're launching their EV scooters into a lot of categories. So those are triggers for the sales to grow. So if those triggers are met for the company, then you have an idea that where the sales might be, let's say 2 years out, when all these triggers are playing out. So you that way you can get a sense of when that sales might be there 2 years out, what's the profit for the company, what may be the EPS, and what's the PE it's available. So that is basically an example of a process, but this process kind of changes depending on the company.
Okay, okay. Thank you so much, man. Thank you.
Thank you.
Ashna, you can go next. Oh, I think she disappeared. Okay. Vishal?
Yeah, hi Tar, hi Krishna, and
Hey Vishal.
especially thanks. Hi, hi. So, just wanted to ask, what is the best cost efficient and time efficient way to enter into US or other country stocks? Maybe a good user interface also. Which app is good?
Sure. So if you want cost efficient way, and you are not someone who does bottom up stock picking, or allocates enough time into that, or has an inclination to do that, my advice is just buy a index fund from India. That's the best cost effective way. For example, Motilal Oswal Nasdaq 100 mutual fund has an expense ratio of, I think, less than 0.15, so, or 0.5. So with a ETF you can even go down less. Other than that, transaction fees and stuff is very important to me. Like, there shouldn't be a lot of transaction fees or a lot of money wasted in terms of actually transferring money into US dollars. So for after considering all of that, I landed on Grow, GROWW. That's the app name or the company's name that I use, and I use them primarily because they don't have any transaction fees. They are pretty responsive. I've kind of called them up and kind of asked them to add stocks and they have done that within an hour. Um, the amount of money required to transfer is standard, $1,500, irrespective of whether you transfer 1 crore or 1 lakh rupees. So that way it kind of works out.
So the currency conversion cost is also not fluctuating, or like
Yeah,
conversion to
so
US dollars.
that depends on the market rate, whatever is going on that point of time. But if you kind of use any bank to transfer money into the grows partner in US, they will charge you $1,500 to transfer it. Your bank will technically charge you that much money. So since you have a standard cost, a fixed cost around transferring money and zero transaction charges, uh, then they don't have any like maintenance charges or any transaction cost, anything.
And
That's all.
are there any double tax implications if you earn in the US equities and something like that, or it is okay?
There is a taxation, but it's very different for everything. So I do write on my blog post called investkaroindia.substack.com. If you go there, there's an article there called How to Invest Internationally. And I've kind of written down in much detail as to what's the cost for each bank in India to transfer, what are the various platforms available to invest, and also how the taxation works. So you can go there and kind of has all those details.
And yeah, Tar, I just had some industry guy told me that since the US dollar seems to be in a long-term bear market, so will it have an impact on US technology stocks and Nasdaq? Or do you have any opinion on that?
No opinion. So for me, I consider economists and people who predict where something is a bear market kind of equivalent to soothsayers. So good luck to them and more power
Mhm.
to them. But I can't see whether
And
dollar will be in
and
a bear market and not invest.
okay, and last thing is you had a Mastech entry with a 15% weightage. So wanted to know,
Yeah,
was it your 15% of Indian portfolio or your overall global portfolio?
Indian portfolio.
So between India, you say you are having 70% and globally 30%, if I'm not wrong. And
Yeah,
then out of, okay,
75% of my net worth is in equities. Out of that 75%, 30% is in, let's say, global stocks. The rest of it is Indian stocks.
okay, got it. Thank you so much.
No problem.
Yeah.
From past few months, and it has been nothing less of miracle learning for me.
Oh, thank you.
Uh,
Thank you. Very kind of you.
yeah, so I'll get straight to the
Sure.
question. I just wanted to know, with the tapering that has been going on
Yeah.
currently, and there's a lot of news around, the liquidity being available. That is what is driving the prices right
Mm.
now, because a lot of companies have gone overvaluation. Like if you take something like an IRCTC, it was at a point trading more than 350
Yeah.
PE. So even though it's a monopoly business, but at a certain point of time, even the good companies, you have a valuation stretch.
Yeah.
So doesn't that change your, like you just told about IEX also? So doesn't that change your perspective on, your stock selection?
Yeah. So first of all, not all companies are. There are pockets of overvaluation. Like for example, there's so many companies that are available for incredibly cheap today in the stock market. Like if I like India Bulls Real Estate, uh, for a company in that category, like look at DLF, look at Oberoi, what they're trading at and what their market cap was, and look at India Bulls. So that's one example. Look at Jubilant Ingrevia, or even companies that I don't own. Look at SDFC Bank, look at ICICI Bank. They're all pretty cheap. And even in PSU themes, you can kind of get pretty cheap stocks. So there are one or two stocks or very small pockets of overvaluation. And liquidity taper tantrum doesn't impact that much. If you go back to 2013, there was a taper tantrum back then as well. And look what the stock market did. It threw a tantrum. It went down for a couple of weeks, and then it corrected itself upwards again, and then nothing happened. Fed didn't stop taper tantrum. Tapering that point of time, stock didn't cut down its buying program. So now also they are doing the same thing. They had increased their buying because of COVID, but they are going back down to pre-COVID levels. They're not stopping it completely. And these things, honestly, I don't really pay a lot of attention to. Simply because think of it this way: if you were running a business today, and that's your entire sole income, would you be considered what US Fed is going to do to think about whether you should open your shop tomorrow or not, or whether you should change your business strategy? You will look at what the sales of the business are doing, or how much profit is doing, whether my customers are happy, uh, those kind of details to decide how your business should perform, rather than what US Fed is going to do, or what China is doing, or what Indian who's the PM in India, which party is the ruling party. All of these things don't matter to you as a business person, so why should it matter to you as an investor? Because at the end of the day, you're buying pieces of business in others companies. They're just publicly listed. That's the only difference.
That's a great take on this thing. I just wanted to know another few things. One of them, like, let's say you get into a good business at a decent valuation. Just for example, I know you've already spoken about Loris Labs a lot in the past.
Yeah.
So let's say you get into Loris Labs at a really good, sort of doing your technical valuation. Let's say 20 demo, you've just taken it at that price, and then suddenly, the result doesn't come good. There's a margin pressure, and now there are a lot of news going around that once its capex gets over, till that time it'll be in the consolidation sort of a phase. Only then it's a breakout. So your investment is kind of stuck for that particular portion.
I don't see
How
it
do
as
you
stuck.
manage like these sort of things, saying that okay, so if this is the scenario, this is what you can weigh down on, because it's a really good company at a really good valuation.
Yeah.
So how do you
But
like sort of
so
modify these sort of things when they happen?
yes, so I'll give that I'll answer it with two examples. So, for example, with Loris, I'm already invested in it. It's one of my top holdings in my portfolio, and so that being the disclosure. Let me say a few things that I don't think that there are. Let's say I can't guess the future. What the I can take an educated guess of what the revenues will be, let's say a year out. So that's where my focus is. And I know for a fact that Laurus's revenues will be much higher than what they are today in a year from now. So from that point of time, I kind of take an idea of what the sales might be, go back to what profit margin may look like in its couple of cases. Let's say it's depressed, in a depressed case, in a good case, and let's say in a best case scenario. And from there I kind of assign probabilities to it as to what things should go wrong for that scenario to not play out. And if I'm kind of monitoring for those probabilities, I'm good and happy with. And now let's say a similar investment I had done in Strides previous quarter, and for me there, when I made that investment, I saw value in them demerging their biotech business, uh, and everything that was playing out based on till previous quarter's result. um, for me, when I made that investment, I knew the areas of risk. I knew that that was the group where they kind of keep changing their strategy a lot, and that was a group where the industry structure can change overnight. So when that happened in let's say previous quarter's result, I took the money out immediately, and I had significant allocation in it. I had already hedged my position based on all these risks that I was aware of, and as soon as that risk played out, I immediately took a loss and I cut that position. Had I not cut that position immediately, then I would be sitting today at almost around 40% loss in that position. So, but because I was able to know where the risk was and what triggers of risk that I need to get out on, uh, when that played out, I was able to make quick decisions and cut down my losses. So that's the way I think about it. Loris have not sold a single share because I know they are not going through headwinds. They whatever they had the business or margin contraction, which uh, the world is kind of for obsessing about. They had 3% margin contraction. It's still a 30% operating profit margin business, which is expanding, getting 10 years kind of deals. So for me, that business trajectory is going to be very different when it comes to Strides. So you got to look at the business and what it's going to do in the next 2 years, and know where the risk lie in the business when you're making that investment. If you are optimizing and only focusing on the risk side, you wouldn't care about everything else that's happening, and you would also know when to get out.
That's a great insight. Thank you for that. My final question on the Indian market is, where do you see the value unlocking happening in the next decade? Like, I know EV segment is one of the segment, but currently there are a lot of multiple players, multiple pockets of value that you can see. I can see BPCL, IOC, and all the PSUs getting into the charging stations, or I can see a lot like Tata Power, someone like a Tata Power getting a foreign investment exclusively for the EV business. So, where
Yeah.
do you see value unlocking in the next decade in the EV business, and any other theme that you're looking for a decade point of view?
So again, I will make educated guesses there. I look at like trends and what's happening in the world and what India is going through and what the policy is like. So first is like you said, EV. EVs is part of it, but I think electrification in India is going to be a much bigger thing. Green energy and electrification of everything and moving away from fossil fuels is going to be a bigger thing in India, simply because like 70% of our energy is imported, and the government is very focused since the last 6 years to kind of move away and go from an energy import country to kind of energy abundance country. So that's one. Second, I think manufacturing in India is going to play out pretty well. Most of the manufacturing in the world it will eventually move there to India. And while saying that, I also know the risk that I need to monitor is if Indian government kind of doesn't push enough infrastructure reforms around it. If the land availability, for example, is one of the biggest issues when it comes to setting up manufacturing plants in India. If land reforms are not there, if infrastructure is not government made industrial infrastructure is not available on ports or on thematic areas, like for example they have a chemical city, they have a pharma city, things like that don't happen in India, then that will suffer. So look at trends globally, look at what's happening, where the big money is going to, uh, like Reliance and Adanis and Ambanis are not gonna spend billions of dollars setting up renewable plants if they didn't know that in the next 10 years or 15 years that's going to be big business for them.
Thanks for that. Since you mentioned China, this is my last question. We have seen recently that China had a crackdown on its big tech companies, and then with the current focus that China is having on, the climate changing and all, don't you think, being bullish on China for the next few years at least will be a little difficult because they are coming down. That's what China is famous for, right? The manufacturing and their own the capability that they have amassed over the years. And now that the government itself is coming down on these particular things. So where do you think now the pocket of their own value creation will come from in China? Because this is what it was known for in the past decade.
Yeah, so Chinese economy, if you kind of study the history of Chinese economy and what happened, China is very good at copying things. So if you like, I remember when I was a kid, the whole China thing happened, and suddenly everything was available while growing up. Everything used to say "Made in China," but "Made in China" came with a sense that the quality won't be good, and it was almost a joke that "Made in China" goods are not good in quality. At that point of time, China was merely copying what the world was telling it to do. So manufacturing economies were doing great. China had to move away from that, from agriculture economy to a manufacturing one. So they started making uh, industrial parks, and kind of they had cheap labor. They started inviting people, companies from abroad to kind of give them and do joint ventures with them. So they would give the technical know-how. Chinese government would invest the money in manufacturing, and that's how the Chinese era started for the last 20 years. What's happening now in China's economy is that it's a developed country, and they don't no longer want to kind of keep doing manufacturing. So they are moving away into better technologies. For AI, China is ahead when it comes to US. And what Chinese government is also trying to do, they have learned lessons from the Western world where inequality is the highest. So they have a dream of common prosperity, where you don't have billionaires and as well as famine in the same country. So they kind of trying to balance between the two. I've also written about it on my blog post, investkaroindia.substack.com. You can read about it on China. So I do think it's kind of blown over the proportion. And if you kind of look at the reasoning of regulations and where it's coming from, it's actually coming from their goal of becoming common prosperity.
Right. Thank you so much. I'd also like to thank Krishna for this. This is my first time on this platform, and I think I've had the best experience on such a kind of a podcast or a show. I've never had such an experience in the past. So thank you so much, and thank you so much, Tariq. I really look forward to getting more learning values from you. Thank you.
Thank you. Thank you.
It's all because of guests like Tariq that we're able to host rooms like that. So it's all them. I'm just like creating the platform.
No, thank you for calling me.
Cool. With that, we can go to Rajat next. Also, just a heads up, guys. Please send me the message and raise your hand. Don't do one of the two. Then I can't pull you up if I don't know you, because we want to sort of keep the questions relevant to international investing, and to what Tariq can answer. So please send me the message and raise your hand. Also, Tariq, how are you doing for time?
Oh, I'm good. I think we can do till 8:30, so another 20 minutes.
Cool. I'll check with you again at 8:30 then.
Sure.
Rajat, you can go next.
Hi Tarek, Rajat
Hey,
here.
Rajat.
Yeah, great session, and also I would like to thank you for the demerger dashboard that you have created.
Thank you.
So it's really beneficial.
Thank you.
I have two questions. I think first one you have partially answered, but I mean again asking, what are the emerging sectors that you view in India that can create a really good value for investors? And the second thing is regarding circular economy. How do you view it as a sector globally as well as in India?
Sure. What was your second question around? What kind of
Uh,
economy? Sorry.
regarding circular economy.
Circular economy. Okay, fine.
Yes.
So themes I would say this is still the same, like manufacturing, electrification, green energy. Those are my top three themes in India. And manufacturing is a pretty big theme. Like when I say manufacturing, I'm saying manufacturing of everything, mostly electronic goods, then chemicals, and within manufacturing, you can also look at import substitution. So a lot of we kind of import a lot of good goods from around the world, even when it comes to basic chemicals, simply because we don't have an industry here for whatsoever reason. But a lot of kind of established players have kind of recognized that, and kind of are moving away. So Deepak Nitrite, it was an example. What they did with phenolics, there are at least 100 phenolics kind of chemicals that are available today that are being imported, has a giant market. Jubilant Ingrevia is kind of trying to do the same thing with a dictine kind of chemicals and that chemistry. Uh, so that import substitution along with manufacturing and export is a big theme in my area. And uh, regard rather than EVs, I'm more interested in like electrification and green energy. So that's I hope that answers the first question. The second one regarding circular economy, I mean I believe that you mean like a globalized world, and
तो दे दे तो बहुत अच्छा बात है.
okay. So yeah, with globalized world, I think that's it's always going to be there. But even with the globalization, you do find investment pockets available. So, for example, uh, China was undergoing a significant correction in the last, I think, six for the 6 months. It's going through that. So, if you were kind of looking for value in the world, you would have invested there. US stocks are doing very good today. India is undergoing a correction. So you can invest in Indian stocks and then just play against the cycle. Whatever is going up, don't invest there. Invest whatever is going down. And when it kind of reached bottom, start investing then. And so it's very easy to kind of identify bottoms. Just look at charts. You will find supports and resistances. Look at like a monthly or a weekly chart of that index, and you will be able to see where the index kind of that value kind of stabilizes after that selling kind of reduces down. So you will be able to kind of guess educatedly where the selling might stop or may not go down as much.
Yeah, thank you. Thank you, Tarek. Thank you, Krishna.
Cool. Shikhar, bro, go next.
Hey, hi, Tariq. Hey, hi, Krishna. Thanks for the opportunity. Tariq, so my first question is how should we filter out or, drill down between the top 5 companies or top 3 companies of any particular sector or theme we are following? So for example, like when I started my, following the gaming sector, like which you also pointed out one of the examples. So I went with the, I filter out the companies, but I randomly went with the uh, between top 5 or top 3 with Take Two Interactive and the top Roblox. So for other sectors and themes, how should we filter out?
Okay, sure. So I would take that example of your gaming and kind of elaborate on that. So first of all, when I'm kind of let's say researching an industry, I don't look at one single company. I kind of look at everything in that industry and pick up whatever is available. So in your case, the gaming, I would have first gone to Tencent and tried to understand what Tencent is doing, because it's the leader in the world when it comes to gaming. I would also look at industry reports. So, for example, I would McKinsey or BCG or Google or any of these consulting firms, even the tech firms in some cases, publish reports. So, read that. You will find competitors there or industry peers there. And not all industry peers are the same. So, for example, Take Two is a very established player, but also its business model is very different to what Tencent does, and both those business models are very different to what Roblox does. So just because they're part of gaming industry doesn't mean they are necessarily peers. And because their business model is very different, they can have very different. Uh, Even though they are in the same industry, they can be very different companies, and you can necessarily kind of invest in both without having any over like with overlap between the two. Uh, so so look at consulting reports, look at research and industry together by taking all the companies or majority of companies within it, and that way you will kind of start identifying peers and areas where some companies has a significant moat. Because you're researching these companies, you would know which company is doing well in a certain area compared to others. Go through their conference calls. Most of the times you will know what is being discussed. If you kind of summarize that into 2 or 3 topics, you would know what the problems with those companies are. Those 2 3 topics are mostly going to be the problems. And let's say Roblox is struggling with user onboarding, for example, whereas Tencent might be doing something else. So you know that Tencent doesn't have the same problem. And because you're researching all the companies under it together, you would also start identifying themes of or patterns of these problems. So if you kind of today, if you research API industry, you would know every company is talking about profit margins being compressed. Every company is talking about raw material costs being increased. So you know that that's not a problem with the specific company. That's a problem with the entire industry, and you would also kind of understand if that problem is more structural in nature or is going to be going away in a few quarters.
Thanks. I think it was very informative. So second, I just want to know about one particular stock. I mean, you can ignore if you're not following or you mind it.
Sure.
So it's more
Sure.
about global online. So if you have any thoughts on the, yeah,
I don't know that company. Sorry, not
that's
following
fine.
it.
Okay, sure. Thank you.
Cool.
Thank you.
Let's move to Raghav next. Also, just wanted to mention, guys. Right now, I'm not pulling up any more people. Let's get till Satisha, and then we'll see. Depending on if Tariq has time, only then will I pull up more people.
Cool.
Yeah. Raghav, you can go next. Wait, I think Ashna has joined us. Ashna, do you want to go next? Okay, I think she's on a call. Raghav, you can go next.
Sure, yeah. Uh, Thanks for pulling me up, Krishna. And I'm looking forward towards a master's in finance and considering UK to be the first option. But Tariq, what do you feel about like the financial markets in UK? Since you said that they have been bearish for quite a long time now. So where do you think working and pursuing a master's would be better? Like New York City, or would London be okay? Um, okay, so I don't think there's any correlation between how the market is doing versus career opportunities in that country. Uh, so London, for example, is the center. I would ignore your markets question, and I'll just try to answer the in terms of finance areas. So London is the center of the financial markets in the world. If you're kind of looking at investment banking, if you're looking at private equity or even venture for, not venture that much, but private equity and investment banking, then you can, or even equities portfolio management. I think London is a good place to be at. Um, Second comes New York. Then I would say Singapore, and then probably in India, Mumbai. But that's on the front part of the thing. If you are looking at just like working with an investment bank, not necessarily managing money, then Bangalore, Hyderabad, London will not. London may not have those kind of jobs, but you can kind of get them in Amsterdam and other areas. Venture funds, I would say San Francisco is the area where you should be at if you want to be at the heart of all the VC action. All right. And what do you think about the uh, like UK market as a whole? Like, what stocks will you pick? Like value stocks right now? I don't have off the top of my head what stocks I'm going to pick. But the reason I say UK market hasn't done well is mostly because uh, they were undergoing Brexit. They had their main monetary policy decided by the European Union until last year. So, and they kind of have the world toughest regulations in the world, which is good in some aspects, but also kind of hampers businesses growth. So it costs more to do business in European Union, costs more to do business in UK, and that's why you don't see a lot of companies kind of they didn't have a startup boom like China, US had. So within UK, I have a few companies that I'm looking at, but nothing investment worthy. All right. Okay. Uh, Thanks a lot. That's all I had to do. Thank you.
Cool. Let's move to Amitabh.
Hi Tariq, how are you doing today?
Hey, I'm good. How are you?
I'm good too. So sorry, I might have missed out the initial part of your lecture, but probably I just have one question in terms
Sure.
of you talked about China investments.
Sure.
So how do you see the mega trends happening in China? Which investment themes within China do you see as most compelling right now? Because I do track some of the China themes. So probably one sector I look into is the healthcare, biotechnology, and the other one is the 5G technologies. But
Sure.
what are the other sectors that you do track, and how do you incorporate this ESG investing into your considerations regarding China?
Okay, sure. So first part of the question, what themes I'm tracking in China? I'm mostly concerned when it comes to China. I'm not looking at medium or a mid cap or a small cap kind of a company. I'm mostly concerned in the top 15 companies to look out for. And the reason I say that because those top 15 companies are so cheap today compared to where their peers are, global peers are. For example, Alibaba, Tencent, you can buy pennies on the block for those companies. So that's why should you scale down to mid scale and small scale companies if you can do that? Uh, when it comes, so that's where I kind of am focused at. I'm more focused in terms of when it comes to China, I'm not really focused on uh, themes per se. I'm more
Mhm.
focused on individual bottoms up companies in that area. And what was your second question?
So, in terms of considering the ESG,
Yeah, I don't care about
okay,
that.
yeah,
So I
got it.
I look at bottoms up stock picking and themes.
Great.
I do look at what companies can benefit from ESG if I am trying to invest. So, for example, when I bought Tata Power last year during the correction, uh,
Hmm.
it was available for pennies, but they had a very good renewable portfolio. At that point of time, market wasn't giving any value to renewable. I bought it around between 30 to $50 per share. And one of the reasons where I kind of wrote down re-rating of the company was because of ESG into their renewable portfolio. So not necessarily looking at what ESG, the investment needs to be ESG specific. I'm considering if a company can kind of get easy ESG financing, and can ESG money chase that company in the future.
Perfect. Thanks a lot.
Thank you.
Hi, Satisha. You're next.
Hi. Yes, yeah. Thanks, Krishna. Hi, Tariq. Good evening. Yeah, I have a
Hey,
question regarding allocation with respect to Indian market and US
sure,
market.
sure.
So, if you see last 10 years, right, India hasn't done great in terms of dollar returns. It is
Yeah,
substandard. Yeah, it's
yeah,
not done great. Absolutely, it would have done. And if you consider inflation also, then whatever returns we have got in Indian market is not up to the mark.
yeah.
So, if we need to consider next 10 years of investing, so with dollar with rupee getting depreciating against dollar as a hedge, so what do you think about the allocation we should have towards U.S. market versus Indian market? Should we flip the allocation to say more towards U.S. and less towards India, considering the inflation pressures and rupee depreciation and U.S. market considerably well similar to Indian market? So that is a question I have.
Sure. So, in your question, that decision would apply in two cases. One is if you are only doing index investing, you're not buying individual stocks, then you can kind of uh, decide whether you want to be US specific heavy or India or China. In those cases, it makes more sense to be a US specific heavy rather than India, simply because the indexes change and US index is more tech heavy. That's why it has done very well over the last decade. India, you say, hasn't done well, but I can name you 10 stocks off the top of my head that have given 100 bagger returns in the last 10 years in India. So, while the
No,
index may
my
not
mind was
have
more
done,
respect to the overall market, Tariq. It is not. Yeah, individual
yeah,
stocks, of course, they are available in both the markets. So if
yes,
as a person, say I don't invest, it's very difficult to find individual stocks, right? You usually invest in
okay.
the market. Yeah.
Yes. So in that scenario, then it makes sense for you to kind of have, let's say, a decent enough weightage in a US index compared to an Indian index. So if I were you, if I was just kind of investing in indexes, I would kind of put maybe a third of my portfolio in US index, a third in Indian index, and rest of it I'll kind of split it up between uh, China and maybe Indian mid cap or small cap. So that makes sense when you're kind of doing it at an index level, because it's index is just a summation of everything that's going on. But you don't have, if you're a bottoms up stock picker, you don't have to kind of go through that. And in dollar with respect to INR, um, I mean, it makes sense when you are living off globally. If you're living off in India, how does it matter? Your INR is still, you're spending in INR. So if you don't have a, let's say, if you're not doing 6 months in India and 6 months in US, then that doesn't really matter that much. Or if you don't have any plans to kind of get out of India in your retirement and kind of go to US to spend in dollars, then honestly, the INR and US dollar kind of debate doesn't have that much weight on it.
Yeah, thank you, Tariq. Thanks a lot.
Thank you.
Cool. Kamal, you're next. I think we have a few people who've raised their hand. How
Sure.
many more people can you take?
Let's do 10 more questions. I see 10 hands raised.
Okay, cool.
Cool.
All of them haven't sent me their questions,
Sure.
so we'll pull up the ones that have.
Okay, cool.
Okay.
Hello.
Hey,
Good
Kamal.
evening, Tariq sir.
Hey, good evening.
I am invested in microcap stock in India, about 80 to 90%. Please, can you suggest that is strategy right, or I should change the strategy, especially 70% stock in small cap or 80% stock like Agrawal Industrial, which is a very micro cap company, which deals in bitumen road structure.
Okay.
So please suggest me about the company if you know, or my strategy may be wrong. So please.
Sure. So I can't talk about the company. I don't really know the company. I would just say that investing 90 or even more than 10% of your portfolio in a micro cap is not well portfolio planning. And if you have, let's say, at a minimum, the minimum that you can go is have 6 to 8 stocks in your portfolio. Don't go below that number. And you can only do that when you know in and out of the company. You know, you get good information available to you on a quarterly basis. The company is actually managed very well. So I don't imagine Agarwal International or a microcap will have even quarterly results to that extent, or will be kind of holding quarterly calls. So if you're not getting any insight into that company, it's akin to kind of giving 90% of your net worth to someone who you don't know, and with the hope that they will return someday with more than what you give them. So it's not a very good strategy. Think about it in a way where when you know someone, when you're investing in a business, would you invest in a business which you know nothing about, or would you invest in a business where you know something, where you kind of are, there's at least a website where you can go to, or an investor's query, or investor's desk where you can kind of shoot out your queries to. So think about that.
Thank
And
you, sir. Thank you, sir.
yeah.
But I am invested in infrastructure sector. So last question: infrastructure sector is good or what?
I don't track that sector very closely, so I can't say. I do know that within roads building in India, there's a lot of changes that have happened in how business used to conduct itself. So that segment of infrastructure is actually doing very well when it comes to road and highways building. So any company that is going through that has, the government of India has changed their model where instead of uh, asking the construction player to kind of recover their money via toll tax over a course of 10 years, government kind of pays 50% upfront and uh, helps the company. So because you don't need that much amount of time to kind of recover your money back, a lot of companies balance sheets have kind of become very good because of that. So within infra, road building and national highways building is an area where you can look at, but I don't really know a lot about this sector, so I can't give you more details. Thank you.
Vishal, I think you had one question that you didn't get a chance to ask before.
Yeah, thanks again for giving me a chance. Tariq, just wanted to continue with the Mastech related
Sure.
question that I'm sure you must have compared Mastech with the other IT big companies. Now, IT has different kinds of companies. Like ones are very high technology companies like Tata Elxsi or LTTS or Happiest Minds kind of segment. Then there is a segment which is like a traditional TCS, Infosys service company.
Yeah.
So, what made you finalize on Mastech?
Sure. So I'll give a background a little bit. I was invested in Happiest Minds right from the IPO, and I exited the company early. I thought around 350, 400. I kind of got all my money out, mostly because promoters were selling that point of time, and that's one of the areas where in my checklist where I get out if I see a lot of selling by insiders. Um, so within Happiest Minds, I got out early. But I also have a technological background. I work in this industry. I know what's happening in the IT industry and especially with the digitization. So from that, borrowing what I know, I could see Mastack. First of all, it meets my checklist of a company where it's a small, nimble company, changing the way it kind of does business, has enough triggers in the next 2-3 years, and has a very good uh, free cash flow throwing model. It kind of earned more. It throw like this business model just throws up cash every quarter. So when a company has too much cash lying around, that's a good thing. It's not as big as a problem as having too much debt lying around. Considering all of that, I invested into that company and I was evaluating it for a while. I got in a bit late, mostly because I don't know why. But considering all of that, I think it was available at a very decent value. I think it's still available at a very decent value compared to other companies. So those were the areas that I kind of looked at.
The reason I wanted to ask is my very close friend is a ex Mastech employee. Now he's in the related company of Mastech.
Yeah.
And he had seen the culture almost more than 10-15 years. He was very happy with the kind of care they give as a honest management and everything for shareholders and everything. But somewhere he said that they are not having the power to negotiate all their terms with the clients. Like, generally, they are not so aggressive for business as well as they don't have the bargaining power in their hands.
Yeah, they won't because they're a very small company. Compared to if you compare it Mastech with TCS, TCS can move its foot around and can say no, we will only charge you at this rate, simply because TCS has the manpower and also the skill set. So when a company comes for digitization, it's not just coming for one simple thing, like for example moving on-premise database to a cloud. That's one part of the job. It will also have like 4 or 5 other jobs related to that program. And if Mastech today doesn't have functionality or didn't have functionality until last year, before the Airbuses acquisition, to kind of do everything, they were kind of doing the front end digitization work. With Airbuses, they kind of got a door into way into doing the back end as well. But now they have a lot of cash on their books. They are looking at acquisitions, and they have considerable earnings triggers for the company. So as the company grows up, they will get the bargaining power, because that way they can kind of execute everything from top to end.
And if I wanted to add one more IT company, I own Mastech and TCS. And if I want, I feel I'm missing something like a Happiest Mind or a Larsen LTTS or a Tata Elxsi kind of caliber company. Do I go for a Nasdaq listed company, or you feel India still has good value opportunities?
Okay, so within tech, it's a very different world. So saying tech is like similar to saying pharma, and within pharma you will have a CDMO, you will have an API.
Universe,
yeah. So it's a very broad universe. So in tech, so you have a IT service giant, which is TCS, which can do everything when it comes to IT service, from a database to full-fledged projects. They can do everything. Then you have IT service mid-scale companies like Mastech, mid and small-scale companies. You have some other companies as well which are into verticals. For example, Ramco Systems is in HR kind of a vertical. So that's IT service for a particular area. What Mastech does.
Sorry to cut you short. To just save time of yours and everybody's. Just wanted to ask if LTTS or Tata Elxsi still have value today, or they are over.
Vishal, we can't make this a very stock specific discussion.
Okay.
Also, Tariq is like giving his perspective, I please request that nobody cut him while he's talking. He's like taken his time out and
No,
is sharing it
I
us.
just wanted to clarify my question. Maybe he was answering something very valuable, but that was not my question. So sorry about
Yeah,
that.
no, no, that's okay.
Yeah.
So I was saying that LTTS and Tata Elxsi are into servicing of contracts. So Tata Elxsi, if you go through the history, they have tried to kind of do a lot of things. They were once into VFX as well, uh, but that didn't work out. So Tata Elxsi, Kipper Technologies, LTTS is also they're not in the same park. You're trying to compare, let's say, an API company with a CDMO company. If I kind of take a pharma example, so Tata Elxsi and Kipper Technologies is maybe can be grouped together, but LTTS would probably come with the likes of TCS and stuff. And if you kind of go down the market cap, then you will get a Mastag. If you go further down, you will get some other company.
Okay. Thank you. Thanks again.
Thank you.
Yash, can you please mute yourself till your turn comes? Akash, bro, you can go next.
Hey, thanks, Tar, for your valuable insights and
Hey,
Krishna for the
Akash.
room. Uh,
Hey.
so I pinged you the questions, so you can take it in the order that you want. I mean, these
Sure.
are relevant. So, yeah, please go.
Akash, you'll have to read the questions out. You send them to me
Sure.
just for like
To Tar
verification.
as well. Right. All right. So, my first question is, if I'm an absolute beginner for international individual stocks, so what would be the best broker? Would it be something like Charles Schwab, or which one should I choose? That's question number one.
So it depends on where you're living. Are you in India?
Yes, I'm in India, but I'm also invested in investing in East Asian stocks and in Europe as well.
Okay, so the Charles Schwab, you can only make an account if you have a US account. Uh, like, I don't think they service to an Indian account. Like to transfer money to Charles Schwab, they you won't be they won't have a service in India. Um, in terms of, let's say if your portfolio is less than 1 CR, I would say go via Grow. It's the cheapest option available. No transaction fees. If you have portfolio more than 1 CR, go via Kotak or ICICI, one of the big ones. They will give you more catered servicing. And if you don't care about servicing as well, you don't care about transaction fees that much, you want the ability to invest everywhere in the world, then you can do via interactive brokers. So those are the three options. There's an article on my blog Investor India at substack.substack.com on how to invest internationally. I've given a very detailed view of what the pricing and where you should go to depending on what your portfolio size is.
That's very valuable. Thanks. So Kotak and ICICI also give me the so my portfolio is below one. So do they also give the ability to invest in like individual stocks?
Yes.
Perfect. So just wanted your perspective on mobility stocks like Rivian, Arrival, and Tesla. And like there's a dip right now. So should I participate?
Okay, so I don't know when you should participate, when you should buy, but there's a thread on my profile on proxy investing, and I would only say that I because I got a lot of questions on EV in this webinar or this um conference, and I get a lot of questions from everybody who's like even my parents. They are all into like, why are you not investing in EV stocks? When the transition from horses to actual combustible engine happened in cars in the early 90s, most of the car companies went bankrupt. So many car companies went bankrupt in US that you can go to Wikipedia, just Google search list of bankrupt car companies, pick a letter of the alphabet, and you will find at least 10 names by that starting with that letter. So EV is also going to be a similar kind of a journey. there will be a lot of players entering the market. It's a very large market. It's a very big event that's happening. A lot of money can be made, but that also attracts a lot of competition. You wouldn't know whether a Rivian tomorrow may succeed, or whether it will be a Geely Motors in China that will succeed, or whether it will be a Tesla. You also don't know where the market is going to come from. There's a lot of open questions, and as long as there are open questions, you can't assign probabilities to those questions, and without assigning probabilities, you can't determine a path that might take place, or what the outcome may be like. So when it comes to EV space, I prefer going the route of maybe uh, uh, like a ARC fund you can buy, which is investing into all, or EV thematic kind of a fund if you want to take into consideration, because most of the companies will go bankrupt. Some of the companies may not go bankrupt. Or I invest in a level higher up. So for to making electric vehicles, you need batteries. So I'll look for battery companies. There's a company in China called CATL, Contemporary Ampere Technologies Limited. It supplies batteries to all over the world, including Tesla. Pick up its chart, look at its chart. CATL is the ticker name. Look what is done in the last 10 years. It's on single trajectory up. So that's a more sophisticated and a more sure shot bet for me than buying, let's say, a 10 EV names. Similarly, in batteries, I'm not sure if batteries are going to go, which type of battery may succeed. You can go a level higher. All batteries in the world require rare earth materials. So you can buy a rare earth fund. There's a specific fund. There's a ETF that kind of tracks rare earth metals. You can invest in that. That ETF is kind of also doing good. So with each level that you go a little higher up in proxy, you kind of reduces your risk down by a lot while also retaining the upside.
That was extremely valuable. I do understand the industry of mobility a bit. But thanks for the this reply. So just two short questions. One is
Yeah.
so for people who have seen Bloomberg Terminal and have a bit of understanding about it. So just wanted to understand from you what are some alternatives to it. For example, if you wanted to know about the consensus of analysts for a
Yeah.
particular stock, and
Yeah.
people who do not have resources like reports from Credit Suisse, Bernstein, and
Yeah.
GS and all of that on
Yeah.
a daily basis for all the stocks. So that's question number one. And the second is maybe this can be taken on later individually. Uh, your understanding of syndicate networks in India for Indian stocks pre-IPO. Thanks.
Sure. Sure. Okay. So first one is, where do you get material like Bloomberg Terminal? So simple answer is you have to search for it. Bloomberg is able to charge that much a year, 18 lakhs a year for just a terminal, because it kind of gives you all that information. There's no other place. But you can get parts of it. So, for example, research report, go to trendline.com, make a free account, pick up any stock, and they will give you free research reports around it. There's a website called rakeshjhunjhunwala.in, I think, that also has a lot of research reports. So you have to hunt for those research reports. WhatsApp groups, Telegram groups usually kind of forward a lot of research reports. So you can get research reports available if you kind of look around a little bit. Consensus and stuff, you don't find it easily, especially in India. But you can still find out for US stocks on a Yahoo Finance, or some other, like there's a terminal called Atom, which is also kind of almost free. You can use that for US and international stocks. And if you are someone who can afford a Bloomberg but may not buy a Bloomberg, you can go for a Thomson Reuters Edison, it's called. So it's not as expensive as Bloomberg, but still cost a couple of lakhs a year.
Can you please repeat the name again?
It's called Edison from Thomson Reuters.
All right, and thank you so much for the valuable insights. So within the reports which you mentioned, My only concern is how do you check the validity or the authenticity of the analyst, right? So, couple of years back, like crypto
Why don't
1.0.
yeah, yeah. So the analysts, I can tell you, I was in that industry. They're looking at an Excel. They're looking to do their job and get their manager sign off on that report and publish it. Their kind of job is not tied to if the stock actually meets the target or not. There are analyst rankings in the world. You can Google them, global equity analyst rankings, and you can find analysts who have consistently met their targets. But when I'm looking at research reports, I kind of don't look at the target one. Uh, Actually, you can kind of put a blacken that part out and only look at the details, what they're trying to say. And most of the analyst reports will not be that great. I use analyst reports to kind of summarize what's happening, but I still will do my own research. In one of the analyst reports, like you can see projections up till 2041. Most cases they justify valuation relative valuations. And for example, I was reading a specialty chemicals report. They one peer they kind of picked up and they said this peer is trading at that much. That's why the target should be this much. So some cases you things will not make sense, but don't rely on analyst reports. Use them to kind of get a sense whether you're in the right direction or not, or uh, maybe what to get learn about something of the industry that or the company that you may not know. But don't read analyst reports thinking that you will find everything analyst says in that report is 100% correct, because I can tell you 9 out of 10 they themselves don't know what's going to happen.
And about the syndicate networks, how do you track their performance? What metrics do you use? And what are other sources apart from AngelList to know about syndicates for particular sectors?
Yeah, so I personally stay away from syndicate networks simply because I can generate. I've been able to generate 30% CAGR for my portfolio. So until and unless I'm doing that, I don't really need to divert my money away to a pre-IPO or any IPO. But AngelList is a good place. When it comes to syndicate, look at the manager and how many successful investments does he have, and what kind of transparency does he gives you. So there's one syndicate in India which I can vouch for. It's called Better Capital, and it's managed by an ex McKinsey partner. They have had very good exits, and they have a very good capital. So if you very good returns on their portfolio. So if you're investing, look at the manager and their history and how they behave and what their transparency level is like when it comes to syndicates.
Uh, can you provide some metrics for the for classifying successful investments?
Yeah, for me, successful investment would be that a person was able to exit uh, at least at a 3x of their investments in a relatively short period of time. They didn't have any losses. And if they did invest somewhere that they had considerable successful journey. So in syndicate, you have to be early in an investment, and pre-stage IPO, and then series B, series C. You won't find any large syndicate capitals because then you are talking about hundreds of millions of dollars. So you will see VC and PE funds. But if a company has been very good at its early stage and series A, or still even series B, then that's when I'm looking at. I'm not looking at companies that or funds that are very late stage or haven't been able to kind of generate returns within those three stages.
Thanks. It was extremely informative. So, so my understanding is there won't be a lot of mandatory disclosures. So, if you are not invested, if I'm not invested right now, and my quantum or the appetite is small, so how do I actually analyze the different options available within the syndicate networks, or the metrics which you mentioned? Would that be
I
easily
think
available?
Akash, I think you should take this question offline because it's highly specific and it isn't relevant to the larger group. So you can message Tariq on Twitter and take the conversation forward there. I also want to just quickly chime in and say that if people are looking for a low cost sort of analyst space, which is different from what you get from the traditional analyst, you can also look at Seeking Alpha. Um,
Yeah.
their premium subscription costs about $200 a year, and they will give you like consensus estimates of the larger brokers and research firms. You won't get access to the individual reports, but you can see what the consensus estimates are, and you will get user generated data in the form of articles about all the companies that are coming up. And oftentimes I found that they don't sort of always fit the same mold of what is to be looked for in a business, or how to do the valuation. Oftentimes you'll see like very divergent opinions, and I think that lands up helping you grow as an investor a lot more. Also, just to mention that if your question is about how to get started in international investing, I haven't pulled you guys up. I have tweeted out Tariq's article on how to get started in US investing. It's part of a thread where I'm sharing a lot of the resources from today's talk, so you can find the link there to that information. I've also put up Tariq's thread on proxy investing, which is also an absolutely great thread, if I might add. Uh,
Thank you.
Also shared his link on his perspective on China. I'm still personally a bit divergent on that opinion, but I think if somebody in India you should read about investing in China, it's Tariq. So I've posted the link to his China article there as well. So all of you can get access to all of those resources. I just kind of want to keep everybody's time in perspective here, especially Tariq, so that we can get through the questions that we have from the speakers who are currently on stage right now. Uh,
Thank you so much, Tariq and Krishna, for the opportunity.
No problem.
awesome.
Thank you.
Nikhil, do you want to go next?
Yes. So my question is specifically to do with the future of competition between vertical e-commerce players and horizontal e-commerce players. So, I mean, the perspective specifically with regard to the beauty industry, is there any learnings from the US market and other international markets? Because having worked in the FMCG and specifically in the personal care and beauty industry for more than 5 to 10 years, I can see definitely for a fact that valuations apart, the whole concept of in India, for example, Nika's whole concept of selling with beauty advisors, you can't sell beauty and personal care without a beauty advisor kind of a thing.
Yeah.
That whole concept plus
Yeah.
selling also, if you go through the portal of Amazon and Nika, obviously there is a vast difference in beauty. At least it seems to me
Yes.
the depth and product coverage is much higher. So, in a nutshell, beauty and any other industry you can think of, what is the future of vertical e-commerce versus horizontal e-commerce? What is the US and other developed markets kind of history of that, and how is it changing going forward?
Sure.
Like you
So
were saying.
when it comes to developed markets, nothing like that has played out. So, and the reason is that US, there's only two developed markets where technology has played a very big role, in China and US. And within US, there's not a lot of vertical specific focused markets. Etsy, I think, is the only one that has kind of uh, gone through the ranks and kind of uh, become a scale where it can compete with Amazon. But other than Etsy, I don't really think there's any marketplace or e-commerce platform in US that is a very vertical specific. Uh, in China, what happened is actually the vertical e-commerce phenomena started in China. But in China, everything is controlled either by Baidu, Alibaba, or Tencent. So Alibaba had an app called Taobao Live, which still is very relevant today, and that led it to kind of create multiple vertical specific e-commerce offerings. At the same time, Alibaba was kind of doing horizontal. So not a lot of competition there. So you can't really say what's going to happen. In India is where you see, let's say, a Flipkart competing or a Myntra competing with a Nykaa, uh, which is very unique to India and how this market has kind of taken place. I don't know what's going to happen. I do feel, like I said about Nika, it can do very well. Tier 2, tier 3 cities are where majority of the market share is, where incomes are increasing, where most of the development is happening. So that's can be a good segue into how Nika may be able to grow in future. And like you said, in the BPC, you need beauty advisors. The way Nika is also able to capture a large share is because they have kind of made a platform and the business model as such that it's kind of telling the users or advising the users what to buy. So
Correct. Yeah.
it's very hard for someone else to copy that.
I'll just add one more thing. I'm a little surprised because beauty per se is a very high margin business
Yes.
across the
Yeah.
world, skincare, beauty. So I'm sure in no developed market is there a vertical leader in beauty and skincare, because in India we currently
Not on an
operate
online.
in
So in US,
not an online.
Sephora
Yeah.
is a like a big chain, which is a vertical beauty only
Sephora.
retail platform, and Sephora has done.
Right.
Nykaa is basically Sephora on the internet.
Oh, got it. Oh, thanks for that. Okay.
Yeah.
Sephora. Got it.
Yeah.
Got it.
But Sephora has always been a physical retail chain, hasn't done online. And it was a very successful business, it still is. It's controlled by the Louis Vuitton group. So, but online players, I don't think there's any. There are a couple of Nykaa copycats in Middle East area, but very specific Nike. Like if I have to pick up Nykaa's peer, I don't find it on a global scale.
Okay, got it. Cool. Thanks so much. Thank you.
Thank you.
Adiaman, sorry if I'm pronouncing the name wrong.
Yeah, thank you, Krishna. My name is Adiyaman. Okay. Uh, question to Tarek. Thank you for answering everybody's question. Actually, I'm the other way around. I have three questions. One is for my personal, and another two is for on benefit of all the followers here.
Sure.
Number one, I live in US for more than 20 years, and I'm investing in US only. But I am the portfolio in India as well. Is there a good idea to invest in India?
When you say invest, you want to move your US portfolio to India?
No. I'm holding everything here, and also in addition to my in US portfolio, I would like to add the other way around. Like I want to 20-30%. I want to invest in India. Is that a good idea to do that?
Yeah, it's always a good idea to geographic diversify. Like not have all your eggs in one basket. Because if I give an example of India and what's happening today, if you were heavily invested into India mid and small caps and not into geographic areas or even the large caps, you would have the last month or last quarter would have really been painful for you. But if you had geographic diversification, like in my case, my drawdown was negligible. Like in fact, I returned 2.2% in the last month. So geographic diversity always helps.
Okay, thank you. And so that means like I have to wait for your target is like 5 to 10 years. Is the long term is the better idea? Is there like your 5 years? Like people are talking
I'm
about
a
stocks.
lifelong investor, so my target is at least 5 years in the short term. But when I invest, I'm investing with a view that I don't have to take this money out from my portfolio throughout my life. I'm kind of building a portfolio where the returns kind of take care of me. That's my goal.
Okay, they're talking about the Sensex, the projecting like a Sensex may touch like a 100,000 in 2025. I don't know it's true or false, but they're projecting.
Maybe not. Yeah, it can happen. So Nifty, for example, can go above 1,20,000 by the end of the decade, and that may seem a lot, but that's actually just 12 to 15% compounded annual returns for the last 10 years, which Nifty has done over the last 10 years. So if I replicate what Nifty has done decade ago, by the end of the decade, by 2031, 32, it might be above 1.2 lakhs, or definitely above 1 lakh.
Okay, excellent. This info for all the listeners can listen. That's what I was asking the question. And another two things is like in US, they're talking about the metaverse stocks is the next level of technology. Have you
Yeah.
done any research on that?
Yes, we spoke about metaverse at the start, and
Oh, I'm
metaverse
sorry.
is a yeah. So
Yeah.
metaverse is a very like it's just being born as an industry. There's no
Yes.
industry as such. There's if you want to understand metaverse, like I'll try to do some art. And that semiconductors, I think Visa, I can say that much that it's in the payment space. And uh, answering the previous question related to crypto, Visa is actively looking at crypto. It has even made public announcements around cryptocurrencies. Mastercard has a platform where banks can kind of opt in to accept crypto payments or move crypto around. So a lot of things are happening in the payments industry, and most of it revolves around blockchain. Everything that's new coming up in the payments industry is either in the fintech space or it's in the blockchain space. And blockchain is actually taking over most of the investments areas. Um, Coming to semiconductors industry, it's semiconductors today in the world is one of the most fascinating places to research into, as per me. Personally, I'm invested in TSMC, which is a Taiwan semiconductor manufacturing company. And if you have studied semiconductors, the entire process and barriers to entry in semiconductors, I think apart from space, has to be in the semiconductor industry, where the barriers of entry is the biggest that can be there in any industry in the world. Um, and simply because it takes about $2 billion to set up a plant to manufacture semiconductors, and the technology has gone to the stage where uh, these are all germ-free labs, where everything is automated, very highly robust technological setup labs, factory units, and very few companies in the world can do them. So in terms of the entire industry, if you divide, you have to divide into manufacturing, which is called the fab business, and also called the design business, which is the chip design. So in the fab business, I think TSMC is one of the best investments today. Then you have Intel, I think, can do very well over the course of next 5-6 years, simply because I think they have changed their leadership, they have changed their strategy, they are getting into fab business as well. They have put considerable, many billions of dollars to make sure manufacturing of chips returns to US, and they have also got the support of US government. So kind of everything has aligned for them. For Intel, they are still much behind. That's why the stock has taken a beating compared to Nvidia and AMD. But I think Intel is a very good bet in terms of value today. Um Other than that, I think all semiconductor businesses are going to do well, because look at it today. Like, there's without semiconductors, you can't sell PS5s, for example. As simple as something very simple, which doesn't have with a demand for something which doesn't impact the price or the market conditions. PS5 sells, PS4 sells like hotcakes, PS5 sells like hotcakes, but they can't do that today because chips are not there. So imagine when you have such kind of a uh, power as an industry to kind of control every other industry in the world, that industry will automatically do well. So those are my thoughts on semiconductors.
Awesome. I think we can move on to Yash next.
Hi Krishna, hi Tar.
Hey,
The
Yash.
question is, how do you think IB real estate will be benefiting from this merger? And when did you enter this, and what's your portfolio allocation? I know it's a little bit specific, but if you want to answer,
Sure.
I'll be, yeah.
Sure. So IP real estate is a way for Embassy Group to kind of IPO or get listed without going through the IPO route. They, instead of going through the typical IPO route, they have gone through the merger kind of a route. And it kind of worked out very well for both the companies, because India Bulls real estate guys wanted to leave the company. They didn't want to be in the real estate business. They want to focus their India Bulls as a company. Right now, they are into a lot of areas. So the promoters have been cutting down non-core businesses and getting into their core competency. Whereas Embassy has a institutional backing from Blackstone. It has a REIT business. So in my view, India Bulls Real Estate can do very well. That's why I'm invested. When did I invest into it? I don't remember the time, but I bought it somewhere around 120 to 130, 140, I think, between that range when it was. And my current allocation on this is around, it was about 4%. I've increased it to about 6%. I may increase it in the future, as and when the Embassy Group mergers kind of goes through completely.
Right. Thank you so much.
Thank you.
Yeah, Saurabh, you're next.
Yeah, hi. Thanks for all the knowledge and opportunity. My question is regarding portfolio allocation. So, what I want to ask is, how do I reallocate the money when a stock grows disproportionately in a very short period of time? Case point being IRCTC. So it has given me like 15x return in a very short time. So
Yeah.
when I'm looking to reinvest, how do I do that? That's the first part of the question. And second part is, I'm a salaried person, and like I get like I put aside a fixed amount from my monthly income in investing. So in that case, how do I allocate? Because I don't want to have a lot of stocks in my portfolio because I simply can't track it. So whether I should increase allocation in my existing stock or like invest in mutual funds, and whenever good opportunity comes, then shift to stock. How do I go about it?
Sure. So I'll answer the second question first. How do you allocate? When it comes to salary, like there's no rule that you have to buy every month. So, for example, I was buying until March. I was buying very heavily until March, April this year, and since then I have not bought a lot. I only bought on areas or days when things have gone down a lot, and that too is not a lot. Like my investment size wasn't that huge compared to March or April. So I've been preserving cash. So cash is your best friend. If you're a salaried person, you will get cash every month coming in. So that's a very good thing. That's an opportunity that you have. Over a long term, that can be a very significant advantage. But make sure that you have enough cash on hand to take opportunities of times like, for example, March 2020, when entire market collapsed by 30-40%. uh, if you didn't have cash at that point of time, no matter how good of an analyst or a stock picker you are, you can't do anything about it. uh, you can maybe put whatever cash you have, but if you don't have significant cash which you haven't been saving up, then you can't do anything. So personally, I don't view that every month because I have a salary coming in, I have to invest that salary. When I don't find opportunities, I just park it as cash. And I would probably, if the parking goes on, if I think within the next year I won't find it, then I will probably put in a liquid fund or somewhere, or maybe even do an FD about it. But I like to keep cash on hand uh, to do it. So don't invest every time. And when it comes to your portfolio, it's always good to buy more of what you already own, rather than chase a new idea. Uh, so the only caveat there is, make sure when you're buying it, that the price is actually, or the value is actually good. So don't buy just because things are going up. Um, Coming to your first question regarding when to sell. So when you buy something, you would have expectations around it, as to how much my return should be. And if a company gives you next 10 years worth of return in a single year, say thank you. So sell that position and take the money off the table if you're not comfortable.
Okay, thank you. One follow-up question, if I'm allowed to.
Yeah.
Regarding, you said it very nice. Cash on hand is like very important, and like I usually have around 10 to 15% of my portfolio.
Yeah.
The amount equivalent to 10 to 5% of my portfolio is cash in hand. So like
Yeah.
over the period of time, it might go up, go down. But like, is it a good amount to hold to take advantage of
Yeah,
opportunity?
definitely.
Like,
10 to 15%, you can even keep it as cash in the portfolio and not allocate it, and only look to allocate it when opportunities like March 2020 present itself. Otherwise, even if it's 15%, yeah, at least 10% you can keep in park it in cash. It won't really impact that much of your returns over a 10-year period.
okay, all right. And the other thing is, you mentioned rightly, like if a stock gives me 10 years worth of return in 1 year, uh,
Yeah.
just exit it. But like, what if like the problem where I find it the most, like when do I exit? Because in certain cases, the returns have exceeded my expectation by far, and I was a bit late on exiting. And in certain cases, the return exceeded my expectation, and I did not sell, and then the stock came down. So uh, I'm not
Yeah.
able
So
to.
So that's where your earnings triggers matter about the company. So that's why I say buy more of the company you already own, because that will force you to kind of study much in depth about what the company is doing. So, for example, today, Loris, I kind of study everything about the company that is there to study about, and every day I've kind of have much more focused uh, my attention on Loris compared to something maybe which I have 1% allocation on. So the more you buy of a company that you already own, it'll help you kind of get focused, especially if that's your style. If your style is that you kind of diversify, then that's also is okay. But you need to know what your style is. My style, what prefers to me is concentration. So I don't really like diversifying and tracking 20, 30, 50 stocks. I like 10, 15 companies that I can track and invest in 8 to 10 stocks. So that's what I do. um, and when a company kind of gives you returns, so if, let for example, IRCTC, if I take the example, it was obviously trading at like valuations that were unsustainable. And when I say that unsustainable, because for IRCTC to kind of even double or triple or 10 times its revenue, then also it will not be a justified valuation for what it's was trading at. So in those cases, it's a no-brainer. Tomorrow, if let's say IEX from here doubles in a month, it goes to over 1500. I'll sell IEX. I don't care whether it goes above 2000 after that, or whether it goes to 800 after that. When you make a decision, you're investing for to get the return for you. For you, if let's say 10% return is good enough for you to live a very good life, then why are you worried about getting 20, 30, 50, 80% returns? The point is not to chase the returns, but the stocks is basically a vessel for you to kind of meet your financial goals in life or the wealth goals in life. So whether it's 10% or whether it's 15%, it depends on you and your goals. But when it comes to booking profit, don't uh, hesitate that what if it's trading at 100, it will go to 150. If you're comfortable with your investment, if you're satisfied that what the return you've got, be happy and book it and move on to something else. You will find some other opportunity.
Okay, thank you.
Thank you.
Tariq, we'll take the last two and then we'll close.
Yeah, sure, sounds good. It's been 2.5 hours.
Yeah, it's pretty crazy when you come on. There's like a lot of demand that's been piling up from a long
Thank you,
time.
very, very, very kind of all of you. Thank you.
Jigan, you want to go next?
Hi, Tarek. Thanks for the opportunity and the knowledge shared in this
Hey,
forum.
Chicken. Hey.
It's actually kind of a similar question to Saurabh.
Okay.
We can't hear you, Jigan.
Yeah, neither can I.
Okay, I think we'll come back to you. Till then, Anurag, do you want to go?
Yeah. Am I audible?
Yeah, Anurag. Yes.
Yeah, so I wanted to ask regarding the Baltic Dry Index. It's going down rapidly from 2 to 3 weeks. How can it affect the markets?
Baltic Dry Index is for shipping, right?
Yeah.
Yeah, so shipping costs are gonna go down. That was pretty like so shipping costs, freight costs was extremely high last quarter, and as bottlenecks in the supply chain are removing, they will revert to mean. So, for example, it used to cost around $2,000 to send something from India to US on a container. That same thing was being quoted for $15,000. So that's the kind of level up that has happened 7 to 8 10x in some cases. So that dry index, that Baltic dry index, will gonna go down and will come back to its mean revert level. So if you want to see mean revert level, then do a monthly chart and kind of uh, do a average or a mean line between that mean median line, and then you will see what that level is.
And can it affect the markets altogether? Like can
Yeah,
we
so
see?
when it comes to affecting the markets, the depressed profit margins that you see today, this quarter, and there will be next quarter also, there will be these margins will remain depressed. But from quarter four onwards, you will see them bouncing back up. And the reason quarter one of next year, basically between from April to June quarter next year, you will see all these profit margins of companies that were depressed. They'll bounce back up simply because your shipping costs, freight costs have all gone down. Similarly, raw material prices are going down. If you look at natural gas prices or aluminum prices or even iron ore prices, they're all going back to their mean levels. So in terms of market, it's a good thing for market rather than bad thing, if that's what you're looking at.
Yeah. And one more question regarding the automation of robots. If you have researched upon the UI path, how do you look forward to it, like in the coming future?
Sure. So UiPath is actually a RPA platform. I use UiPath on my work, and these are basically your product companies, IT product companies. So in the tech question that somebody had, this is basically your it comes under IT products. So UiPath, this company specifically, it's a leader in RPA platforms, and I think it can do good. It's a very overvalued company in my view. But when it comes to, if I chuck aside valuations, it's doing pretty good in terms of your for itself. It's a leader in its market. But these are all your digitization tools. If you don't want to invest in these companies directly, then go for an IT service company like a Mastech or a Happiest Minds. I wouldn't tell you to invest because it's overvalued. But personally, I went for a Mastech rather than a flurry of these products, investing in these specific product companies, simply because whether it's an RPA from a UiPath or an automation anywhere, you will need an IT service firm to kind of service it. So again, going back to proxy investing, that's the way to. That's my thought process around it.
Yeah, thanks. That would be all from my side.
Thank you.
Jigan, are you able to speak now?
Am I audible now?
Yeah.
Yeah.
Yeah, Tarek.
Yeah, go ahead.
So my question was: suppose the companies which we have invested has a long periods of growth, and it's a proxy play for mega trends, and these are one kind of companies with no competition, listed competition, with the predictable earnings cycle and increasing dividends and free cash flow, and I have the capacity to suffer. So both the
Yeah.
company and myself have a high capacity to suffer, and it turns
Okay.
multi bagger. Is it
Yeah.
prudent to reduce the portion size or let it run? Because I have a stringent valuation metrics, and it's not given an incremental entry to add to these proxies. How do you deal with
So it
relaxing?
depends on you. Yeah. So it depends on you. So selling, in my view, is very difficult compared to buying. And I also that are fast growing companies, like you specified, it has become a multi-bagger. That was in its fast growing stage. Every company, when it goes to fast growing stage, will eventually reach to a maturity stage. That's where the earnings will slow down. It'll still be profitable. It'll still be making money. Dividends will increase because the company does not find enough areas to reinvest the capital. So it'll start giving back to shareholders. That's where you can start to reduce down, where you do not see any earnings triggers, and when the company has given you more than enough returns than what you desired.
Yeah, thanks. It helps. And my another question is the transmission line company can be a proxy for EV theme or renewable energy theme?
Not direct proxy. Like you would need transmission. The US is actually going through this problem of their transmission lines are set up based on nuclear and coal plants. Now their area of the sunlight that's the mid part of the US, so they have to kind of set up new transmission lines in going through the mid United States. So those kind of areas might appear where a transmission company might get business because you have to set up new transmission lines from some other geographic area of the country, but it's not a direct investment where and when I say direct, it's not directly correlated to let's say a renewable capacity increase 10x in the next 10 years doesn't mean transmission lines also will increase 10x. So it's not a direct correlation, but indirectly you can.
Thanks a lot for the opportunity. It was an extraordinary session. Thank you.
Thank you.
With that, I just want to thank Tariq one more time. Tariq, this was a phenomenal session. Thank you for giving us 2.5 hours of your Sunday.
No problem. Thank you for calling me.
It was truly incredible, guys. Please follow Tariq on Twitter if you don't. His handle is @it's TARH. I've tweeted it out along with most of the resources that we've discussed today, so you can get access to all of them from there. I've also tagged Tariq, so you can find his Twitter handle. It's right on the first tweet itself. Uh, Srinivasan sir, did you have some closing remarks you wanted to share?
Yeah, thanks, Krishna, and thanks a lot, Tariq.
Thank you.
Because this is the thing about Indians invest globally, right? And one of Tariq's articles on investing in international markets, it's an excellent source for beginners. And thanks, Krishna, for tweeting that. I'm sure people will, find it very useful. There was a very good question about cost efficiency and time efficiency. I thought I'll just add a bit, right?
Yeah.
So even Tariq mentioned that many of the banks, right, charge you between 1,500 rupees for the foreign exchange transaction. So this is not the investment money or whatever. This is just to give you the privilege of getting the money from rupees into dollars, right? And a lot of times this happens the other way also. When you get the money back from dollars into rupees, again you pay this, right?
Yeah.
So because of that, I would tell people that unless you're looking at something like, see, 1,500 is $20, right? And that kind of a fee makes sense if you are investing, if you are transferring say $1,000 or more, right? So unless you are making that kind of a part, right, a direct investment outside India may not really work out for you because you will lose a lot in just the transaction fees, right?
Exactly.
This is like an exit load, right? Indirect
Yes.
exit load that the bank puts. So
Exactly.
I thought I'll just add to that cost efficiencies unless you have that. And as Tariq mentioned, you can invest in Indian funds that are investing in global stocks, right? There are both passive and active. And a very interesting part is that this space is getting nicely crowded, right? And it used to be very, very sparse a few years back. It is getting more and more action, and more choices are coming, right? And including a Chinese tech ETF, right, is going to be offered soon. So you will have a lot of choice. I think people who have a lower kind of investment corpus, they may just want to invest in Indian funds that have a global portfolio. I'll just add that. Thanks, Tariq, for the great information. And
no, thank you. That was a very well point. Yeah.
Cool. With that, we bring the session to a close. Once again, thanking Tariq for a fabulous time. I enjoyed my Sunday. I really hope you did, and we look forward to having you back here again.
Thank you for inviting me. Have a nice weekend, rest of the weekend, everybody.